good afternoon or good evening, depending where you are right now. My name is Jay Shambaugh. I'm the co-director of the Institute for International Economic Policy, or IIEP, as we call it here at George Washington University. So welcome, even though it is virtually, to Washington, D.C. We here at IIEP are very pleased to be hosting this event on India's post-COVID finances as part of our Envisioning India series, and to once again be partnering with our co-sponsor, the Seeger Center for Asian Studies at GW. IIEP is located at the Elliott School at GW and is a cross-school interdisciplinary research center at GW. It aims to be a catalyst for high-quality, multidisciplinary, high-impact and nonpartisan research on policy issues surrounding economic globalization. We consider that mandate somewhat broadly and do work on international trade, international finance, international development, poverty, climate change, and economic policy more broadly. And we've also focused on issues surrounding China's economy and India's economy. We've been very busy over the last 9 or 10 months or so, or 12 months now, with a number of events that are web-based, and you can find all of them if you look for links on our webpage, and we also have a number of events coming up over the next month. We at IIEP have focused on India over the last 5 years quite a bit, including holding a number of large in-person events, and now for the last year or so, our Envisioning India series. Ajay Chibber likely needs no introduction in this crowd, but for formality, I will note he is an IIEP Distinguished Visiting Scholar and has played a leading role coordinating our work on India, including organizing the Envisioning India series. Prior to his time with us, he's held many senior roles at the World Bank, the UN, and within India. So without further ado, welcome again virtually to Washington, D.C. and to GW. And Ajay, I'll turn it over to you.
Welcome to all of you, and welcome to, of course, to our 3 very distinguished speakers today. We are going to speak on the findings of the 15th Finance Commission that NK Singh has chaired. It is actually has been the longest, I think, the longest finance commission. And I remember when I first saw the terms of reference of the commission, this was in March 2018, about 3 years ago. And I wrote a short piece in the Business Standard and I called it a minefield of issues. And I'll explain why, because I thought this was one of the toughest terms of reference with lots of curveballs, if you like, that had been thrown at NK Singh and his commission. For example, the first time the base census was changed from 1971 to 2011, which meant that particularly the southern states and West Bengal and the Northeast, which had much slower population growth, would now feel that they would get less money, and so they would be up in arms. They were also asked to reconsider the high devolution that the previous Finance Commission had just given to the states, which the government itself had accepted, and I couldn't understand why that reconsideration was now on the agenda. And then they were asked to look at expenditure by states on populist measures, whatever that might mean. I mean, is a farm loan waiver a populist measure or a necessity in a time of problems? And then on top of that, there was the abrogation of Article 270 that took place. And Jammu and Kashmir was then bifurcated into 2 union territories, which meant that the work of the commission was delayed. And then, of course, came the pandemic. So I think this has been, it sort of brings to mind perhaps the question, why don't they have a permanent finance commission? But anyway, NK will, with his great skill and ability, will tell us how he negotiated through these minefield, if you like. But before I come to him, let me introduce the other 2 discussants, very distinguished people. Indra Rajaraman, of course, to many people at IIEP, her greatest achievement is that she had a PhD from Cornell University. We have a lot of Cornell people here, Indra, cheering on for you. But I tell them that she went on to much bigger and better things than Cornell after that strong base at Cornell. She was, of course, my professor at my favorite institute, the NIPFP. And then, of course, she was also on the 12th Finance Commission with Vijay Kelkar. And she, in my mind, she's one of the clearest economists that I've ever met. So welcome to you, Indra. And then, of course, I have Junaid, who's a former colleague of mine at the World Bank. But before that, we both have the same alma mater, which is Stanford University. He is, in my mind, one of the world's top experts on subnational finance. He was also the director of the Office of the President of the World Bank before taking up his position on as director for India. He knows India very well, much better than most of us do. So welcome, Junaid. And now let me turn to our main speaker, NK. NK is that quintessential, very rare combination. I don't know, you probably find one or two people like that in some countries, but he's been a government official, a bureaucrat as they call it, rose to very high positions in the Indian bureaucracy in the finance ministry. He's been a policymaker, he's been at the planning commission, he's been on so many commissions before this great one. He's also been a politician, he's been a member of parliament. So he's that very rare breed that understands, at the sort of complex relationships between policy, administration, and politics. So when I wrote that article on the minefield of issues, I said they couldn't have found a better person than NK to navigate through this minefield. So over to you, NK.
Okay. Yeah. All right. Okay. So at the very outset, let me profoundly thank GW University for this privileged opportunity to have an interactive session on this issue of commission. To you, Ajay, for having prompted me to accept this and together the panel this distinction. My relationship with you, Ajay, goes back a long time when in the Ministry of Finance and in other areas which you mentioned, we have interacted. With the two distinguished panelists today, with Indira, a very special relationship because she has been one of my great advisors in the journey that I have traversed on India's policy making. She was a member of the Finance Commission's policy advisory group, and her sage, sanguine, and balanced advice was always an important motivating factor for the Finance Commission to traverse what you called, Ajay, is this minefield laid out in the terms of reference. Junaid, you have correctly said, few understand the issues of federal finance and what fiscal federalism means than Junaid. Apart from his own understanding and the new leadership he has invested in the Office of the World Bank as the country director, Junaid has also been of great value to the Finance Commission in firming up its terms, firming up its recommendations, particularly in some key areas. And I will mention issues of urban local bodies, on issues of environment, on issues of fiscal consolidation, and a number of other important issues which were referred to us. So you couldn't have really got a more distinguished panel to participate in this discussion on the 15th Finance Commission. Now, in the very few minutes which I want to spend, and I do not want to cramp the opportunity for an interactive session, let me begin and go back to the drawing board. Let me begin by saying that the Finance Commission is a product of the Indian Constitution. It's a constitutional body. We know it's older than the Indian Constitution in a technical sense of the term, because the origins of the Finance Commission were embedded in what is known as the Government of India Act of 1919, which laid down the sharing of revenue between the center and the states as a percentage. And then it was recalibrated and given greater content in the Government of India Act of 1938 about the sharing of center resources with states and on the grants in aid that the central government could give for the finances of the state governments. So that really, the two acts taken together, laid the foundations of what may be called India's federalism and India's federal model of governance, which is embedded in the written constitution. The subnational states have got independent powers, they have independent legislatures, they have an independent high court, many of them have a bicameral system, and are really embedded in the key features of the Indian Constitution. In this sense of the term, therefore, when it comes to the demarcation of functions, I want to focus on some key issues on how has this legacy of Indian Federation evolved over this period since its adoption. But the first Finance Commission, as we know, after the Interim Finance Commission, was established after the adoption of the Constitution, and the President is expected to appoint a Finance Commission at the end of every 5 years. It doesn't say for what period the Finance Commission's awards will be covered, and as Ajay very correctly pointed out that in a sense, therefore, this Finance Commission, which really had a 3-year, it was constituted on the 4th of December 2017 and gave its recommendations a few months ago to the President. So we had just about 3 years to address this complex challenge. In this period, we gave 2 reports. We gave 1 report which covered the current fiscal year technically, that's 2021, and then we have given a report to cover the period 21 to 26. We have done so at a time when there are unexpected uncertainties. There are issues on which predictability is more and more problematic. There were times when we felt that we needed more than economic understanding and economic engineering skills and modeling. We needed more than a fair share of what I have called astrology, particularly when it comes to giving an award for such a long period amidst all these uncertainties. So I will come to a few important aspects of the complication ever since the drawing board of the Finance Commission was initially crafted. First, as you all know, and Ajay, you know this very well, the panelists know this very well, that the broad division of functions between the center and the states, and what could be both in the territory of the center and the states, is contained on what is known as the 7th schedule of the Indian Constitution. The 7th schedule is nothing but a division of power, a division of functions between the center and the states, and that which forms what we call the concurrent list in that framework. Over a period of time, of course, I can come to this later, or I can address it in a Q&A. This picture has got somewhat complicated by many factors which have entered the picture, like, for instance, standalone entitlements, standalone parliamentary entitlement on education, on food, on many other areas of which concern us, on family planning. And these legislations, to some extent, transcend, therefore, this distinction in the 3 categories of the center, the states, and the concurrent list. Also, I think that we must recognize that apart from the 7th schedule, there is an additional complication by the introduction of something called the Article 282 of the Indian Constitution. This article enables either the central government or the state government to make any grant for any public purpose which is considered appropriate to serve a wider objective. As a result of this, what in effect has really happened is that as of now, there are 211 category of schemes called the centrally sponsored schemes. But these centrally sponsored schemes typically imply a sharing of the cost of the scheme, where the central government makes a contribution, and more or less, depending on the proportionality, which keeps changing, the state government also makes a contribution. But the important point is, many of these relate to areas within the seventh schedule of the Constitution is strictly in the domain of the states. So there is a huge infringement on the classical neatness of the architecture conceived at the time of the seventh schedule being crafted as the key feature of the Indian fiscal architecture. So there is a seventh schedule and there is Article 282 of the Constitution. This was to some extent also partly complicated by two other features. One is in the 73rd and the 74th constitutional amendment, which recognized and created independent urban local bodies, the panchayats, and what is generally known as the third tier of the Indian government. Now, to what extent the third tier has worked or not worked, but the fact remains that contrary to the constitutional provision, successive finance commissions have given large devolution of resources to the third tier. Illustratively, for instance, this year, we enhanced it substantially from what the earlier commission had given, to giving now 4.22 lakh crores over a period of 5 years for urban local bodies, for the rural panchayats and so on, and to cover all the three sectors in that. So this was another feature which came after the original constitution was adopted. Then there are two other complications which are of a comparatively recent origin, and I must mention. One is the constitution of the GST Council. Now, as we know, in 2017, after about 20 years of effort, India adopted a GST, which is the goods and services tax, a uniform set of taxation covering and embedding all state excise, subsuming them with some exceptions being left aside for a sharing of the resources between the center and the states. And therefore, this GST Council is also a constitutional body, and there are problematic issues on state finances, central finances, on legacy issues, and also the problem of a durable, sustainable, and a credible relationship between the Finance Commission, which remains an overarching body on the distribution of resources between the Union and the states, with the ability to be able to influence the decision of another constitutional body, which is the GST Council. But Ajay, you mentioned en passant that the issue of whether the Finance Commission should be a permanent body or not, I think that I would be somewhat embarrassed to comment on this, because no Finance Commission should look to be a self-perpetuating one, and we would be the last one to walk into this. But the fact remains that unlike many countries, like Australia, which has a permanent grants commission, a permanent expenditure commission, South Africa, Canada, in India, the Finance Commission is not a permanent body. It comes with specific terms of reference, gives its recommendations, goes away. The GST Council is, on the other hand, a permanent body. So a relationship between an impermanent body and a permanent body under the Constitution is another problematic area on which I think that perhaps the last word has not been said. So I'll finish with this and then go to some of the important ingredients of what are my recommendations and why I made them in the way that I did. Why I tried to avoid getting blown off by the carefully laid out minefield to which Ajay has articulated and mentioned at more than one point in time. So to give you a ballpark number, the Article 280 of the Constitution lays down the setting up the Constitution and setting out the broad terms of reference, which is the distribution of the divisible pool, whatever is the divisible pool, between the center and the state, what is known popularly as a vertical distribution, vertical between the center and the states. It's also expected thereafter to give a normative basis that whatever be assigned from the divisible pool for the states, what is the formula on which that interstate distribution would be considered appropriate? So to go back, therefore, to the broad architecture, we calculated, based on our modeling, that the gross revenue receipts, what is known as the GRR, for full 5 years for which we have given the award, would be in the region of around 154 lakh crores. Out of this, take out the obvious ones like the payment of dividends by the Reserve Bank of India, the central government user charges, dividends of other public sector undertakings, a payment of interest on loans to central government. You take out of that the GRR of 153.4 lakh crores. You come to another nomenclature called the GTR, which is a gross tax revenue. When we calibrated that, that gross tax revenue then comes to 135.4 lakh crores. Out of that, then, and this is a debatable issue on which I may comment a little later or can address it in a question, is from out of the GTR, you take out cess and surcharge, which after the 80th constitutional amendment in the year 2000 was not shareable with the states. So the cess and surcharge must be excluded while calculating the divisible pool. And when you take all this big chunk out, the 135.4 lakh crores for that 5-year period, the divisible pool comes to 103 lakh crores. So it is this divisible pool which we needed to assign. How did we do that? So the first thing is we assigned what would be an appropriate vertical share. Now, over the period of time, and who knows this better than one of our very distinguished panelists who made comments on this, that all successive finance commissions have made incremental changes. It has always been a change in upward direction. So it began, the divisible pool concept and ingredients also changed. In the earlier years, it was just the sharing of income tax. Then excise got added incrementally. And then finally, all this got changed in a substantial way by the 80th constitutional amendment in the year 2000, which enlarged the divisible pool to include all taxes, which means include corporate tax and customs duty and the rest of it. But at the same time, while increasing the ingredients of the divisible pool, it had a rider that the cess and surcharge would be kept out of the divisible pool. What were the considerations in doing so? I will not comment on this at this stage. But the fact remains, therefore, that we face the issue of the distribution of the 103 lakh crores divisible pool. So we decided that although the incremental change, all previous finance commissions have made an incremental upward change, I think that the 13th Finance Commission, of which one of the very distinguished members, she's here, and she'll comment on this, ended this by 32.5% of the divisible pool went to the states, and therefore it was expected that this would make an incremental change. But the 14th Finance Commission, in its wisdom, and for very good reasons, felt that the states were not getting a reasonable share, and it made a very sharp upward increase from that figure to 42% of the divisible pool going to the states. In a certain sense, for the reasons that Ajay has mentioned, when recalibrated, it is 41% if you leave out the share of the 2 union territories, which have now become Jammu and Kashmir and Ladakh. So therefore, earlier 42% was applying to 29 states. We now have 28 states. So that recalibrated comes to 41%. We decided that there was little room to make a further upward change in that direction. But we had to also reckon with the fact that there were expectations that given the fiscal pressures of the union government, whether we would consider a downward adjustment of that to a somewhat lower figure. in the interest of continuity, stability, and predictability, and keeping the problems of the state during this pandemic period, we decided to keep it at the same level, namely keep it at 41%. Having kept it at 41%, out of this 103 lakh crores, 42 lakh crores therefore goes to the states. In addition, we also made recommendations for a grant of 10 lakh crores under Article 275 of the Constitution, out of which 2.95 lakh crores went by way of revenue deficit grants, 4.2 lakh crores went to the third tier, 1.22 lakh crores went for a substantially enlarged disaster fund. We broadened the definition of the disaster management fund. For the first time, we covered all the gamut of subjects based on best international practice. We included disaster mitigation, we included capacity building, and we assigned a much higher resources for the 5-year period of 1.22 lakh crores and addressing the National Disaster Management Act of 2005, and of which includes the State Disaster Management Fund and the National State Disaster Management Fund. So, in addition to this, we had made certain sector-specific recommendations out of the grants, which the government had decided to subsume in the exercise of rationalizing these centrally sponsored schemes. There are some small amounts of money which we gave for the state-specific grants on which there is a further consideration. Then that makes us to an important point on the recommendations which we made on a possible fiscal trajectory, because that was one of the terms of reference which Ajay mentioned, which is problematic. What kind of a fiscal trajectory would be appropriate looking at the pandemic? Now, it was clear to us that although I had shared had the privilege to chair the Fiscal Responsibility Management Committee, and my recommendations were accepted in the budget of 2018, which amended the earlier FRBM Act. Although we had done all that, I really felt that looking at the pandemic and looking at the uncertainties, these needed some more flexibility. So looking at the need for flexibility, although most state governments had in their own state Fiscal Responsibility Management Act had accepted a 3% fiscal deficit target, I felt that looking at the current pandemic, at least for the first initial period of 1 year, 2 years, I placed that 3% to 4%. I gave an additional recommendation, which has also been accepted, of a further latitude to the states of 0.5% of GDP for those states who will undertake far-reaching reforms in the power sector. Because our visit to all the 28 state governments, I found that the one big giant elephant in that room was the unsettled liabilities of the state distribution companies known as the state discoms, and that needed to be addressed by structural reforms, for which we have incentivized this by giving 0.5 percentage point of extra borrowing room. As far as the central government is concerned, I also gave them a range, then a flexibility. They have by and large accepted that range, except that in the terminal year, unlike I wanted that central governments to be 4%, they have gone in for 4.5%, but these are early days. The Finance Commission's reports for a period of 5 years. I can understand that there are huge uncertainties and unpredictabilities, both in terms of the domestic recovery process and the global recovery process as well. So this constitutes broadly the broad framework of the recommendations. We are privileged that the central government acting on these recommendations have accepted the broad contours and the broad recommendations. They are fully accepted the devolution formula for 41% of the states. They have fully accepted my recommendations on the revenue deficit grants, given 2.94 lakh crores given to the states, which comes out of the part of the grants of 10 lakh crores, fully accepted the 4.22 lakh crores to the third tier and to the disaster management of 1.22. One part, not a big part, they will redo and restructure in the rationalization of the centrally sponsored schemes, and in the state-specific grants, we consider them. One more issue, I'll comment, two more issues I'll comment and I'll stop. One is at the point, and I must address that straight away, that Ajay raised, very rightly so. That relates to having arrived at 41%. How did I decide to do the interstate distribution among the states? And among the states, I was overburdened as usual by legacy. And legacy always weighs on you rather heavily. So we adopted, by and large, the norms which were determined by all previous finance commissions, namely assigned a reasonable weightage to population, which falls in the category of needs, assigning a weightage to geographical area, which represents needs, and assigning a weightage forest cover, which was introduced for the first time in the 14th Finance Commission, but looking at current ecological and environmental concerns, and not only retained it, but increased it from 7.5 to 10%. So population, geographical area, and forest cover falls in the basket of addressing needs. Then there is a classic issue of addressing the issue of equity. The classic method of doing so is to assign a high weightage to per capita income. In the past, a much higher weightage has been assigned, but we decided to adopt a 45% weightage out of the 100 from which we have to assign for the equity formula based on the income distance method. And we calibrated the lowest and the highest. The highest income, per capita income is in Goa, but we felt it was a very small state. It would be atypical. So we chose Haryana and then looked at the income distance approach, the reverse of it, to be able to assigning a 45% weightage to what you call equity. And finally, and this is the issue that Ajay had raised, we chose for the first time two criteria. We chose based on efficiency and performance. So we introduced a criteria called demographic management. And to allay the apprehensions of those states who felt that Ajay was right, that although from 1974 to 1979, for 40 years, the Commission was using the census formula of 1971. The President this time assigned us the obligation to use the census data of 2011, creating serious apprehensions in the mind of many of the states who manage their demography much better, that they are likely to be great losers in the process if this census data of 2011 was to continue. So in order to soften the transition, in order to mitigate these concerns, we introduced the broad category of rewarding efficiency and rewarding performance by assigning a weightage of 12.5% to demographic management. The benefits were directly related to what would go to those states who had invested in education, invested in health, girl-child education, and we assigned a weightage of 2.5% for better improved fiscal management. So in the horizontal formula, we sought to address three concerns: issues of needs, issues of equity, and issues of efficiency, which we thought was one appropriate way of giving a horizontal devolution which equally looks at states from the viewpoint of their potential and from the viewpoint of combining and optimizing the compulsive issues of poverty with issues of higher growth and higher performance. So broadly speaking, this is the architecture of the 15th Finance Commission. Some of the issues which I have mentioned are the challenges, will be the challenges as we go forward. These challenges would need to be addressed in a reasonable way. The challenge of the future of the 7th schedule, the challenge of the future of the GST Council, the challenge of the future use or excessive use or misuse of Article 282 of the Constitution, the challenge of how to deal with the constitutional obligation under Article 73 and 74, combined with the obligation on the states to augment their own consolidated fund based on the recommendations of the State Finance Commission, and the challenge of calibrating a fiscal consolidation roadmap, which is somewhat symmetric and which does not really put the states at a disadvantage. Finances of subnational government, and the challenge which the Finance Commission faced were in many ways unique. Ajay, you pointed out, and I will end by saying that since the caption of this Finance Commission, in the Finance Commission in COVID times, how did we take note of the COVID times? We took note of the COVID times by, for the first time, having a robust chapter from the health sector. We assigned 70,000 crore to the third tier, addressing issues, primary health centers, municipal hospitals, district hospitals, testing laboratories, infectious diseases hospitals, of in many ways addressing at the cutting edge the deficiencies in the health infrastructure, also in terms of subsectoral issues of health. That was one direct way we are seeking to address the pandemic. The other way which we are wanting to do is to recognize that during the transition, states' revenues were greatly stretched, and giving a somewhat more flexible fiscal trajectory and a roadmap on the realization of preferred debt targets, we felt that that was one way also we were looking at that important issue. The issue, therefore, of the pandemic, we believe, has been addressed in a reasonable way, not only in the health chapter, but in many other chapters, which have bearing on the overall or overarching theme of the Finance Commission in COVID times. Thank you very much, Ajay, and pardon me if I have overstretched the time and overstretched your indulgence. Thank you.
Terrific, thank you. That was a fascinating tour of what the commission was charged with and accomplished. I'd like now to start with the first of our two panelists to discuss this, Indira Rajaraman, who Ajay has already introduced, and for those of you who would like to see more, the bios of all the panelists are on the website. So, Indira, please.
Can I be heard?
Yes, you can.
Can I be heard? Yeah. Okay. Thank you very much. I presume I have, how much time do I have, and who will signal the end of my time?
You have 10 minutes to start, and we can interject to signal to you
yes,
when you're getting
please do. When 9 minutes are over, so that I can wind up. Thank you. Okay. Thank you very much for this opportunity to respond to NK Singh's brilliant summary of the 15th Finance Commission report. It's an excellent report. It's very voluminous. It stretches into 4 volumes, and it is very detailed. It has excellent data analysis, and I think it will be a go-to reference source for all students of fiscal issues in India. That said, I want to, before I go into the major contributions of the report in COVID times, which is the focus of this discussion today, I want to mention one point in connection with the recommendations of the report, which I think does need to be focused upon. A Finance Commission report is a body of recommendations. It is admittedly a constitutional body appointed by the President of India, but it stands as a body of recommendations. Those recommendations get translated into statutory commitments to states only when the government of India actually accepts those recommendations in a formal way. The Constitution requires that when the report is tabled in Parliament, there should at the same time be something called an action taken report, or sometimes it's called an explanatory memorandum, in which the government formally states the recommendations of the Commission as required under the Constitution, and then formally states whether it is accepting them or not. Under the Constitution, all that the government is required to do is that it should take the recommendations of the Commission into due consideration. It does not have to accept them. But a convention has grown up over the years, a very good convention in my opinion, whereby all the quantified transfers of finance commissions, excuse me, their recommendations in terms of the monies that should actually go to states every year as part of their tax share or as an absolute grant, all of those are accepted as recommended. This time, for the very first time in my memory, the action taken report did not accept all the recommendations, all the quantified recommendations for statutory transfers to states from the center. It did accept, as NK Singh mentioned, the tax share. It accepted 3 grants, the grants to local bodies, the disaster grant, and the revenue deficit grant, which is basically a top-up grant for those states which cannot meet their current expenditures out of their current revenues, even after receiving the projected devolution from the center. So what was left out? What was left out were 2 categories of grants to states which are specific and tied to certain purposes, which the Finance Commission, in its collective judgment, believes to be important enough that it should be incentivized by transfers of that kind. And this time, the 15th Finance Commission, in its terms of reference, was actually formally asked to do so. They were asked to prescribe performance conditionalities to improve the performance of states on certain sectoral issues, which they duly did. But those recommendations were not accepted. The sectoral grants in particular, the response of the government was that these recommendations would be taken into consideration while drawing up the centrally sponsored schemes, which are transfers going to states from the center outside the scope of these statutory transfers. So you might well ask, what is the problem? If the government said that they would take due consideration of what the Finance Commission recommended and that they would transfer these funds to the states in other ways, merge them with pre-existing transfers of the non-statutory variety, what's the problem? The problem is that the centrally sponsored schemes, and NK Singh mentioned that they are co-funded by states, so there is a problem with that. Some states are not able to finance the co-funding. There is a more serious problem with the flows under the centrally sponsored schemes, and I have written about this. And that is that these flows, these non-statutory flows under Article 282, because they are non-statutory and are not subjected to the discipline of statutory flows, the timing of these flows is extremely uncertain. At the receiving end, especially in health grants, which I focused on in a paper, which I wrote after the beginning of the COVID crisis, the funds, for instance, under an integrated disease surveillance program, and what was COVID about, if not about disease surveillance, these funds might reach them a month or so before the conclusion of the fiscal year. So this is why, even though over the years, expenditure provisions in the budgets of the union government have been very generous when it has come to provisions for health and education and so on. They could have been higher, but they were there. But they were not effective, and not effective because their timing was so uncertain. So as far as I'm concerned, the transfer of some of these sectoral concerns from the statutory portal or the statutory platform to the non-statutory centrally sponsored schemes platform is more concerning than just a matter of them coming under Article 282 or requiring co-funding. It has to do with the fact that those flows are not very disciplined in terms of timing, and therefore they become very ineffective. In terms of total magnitudes, what does this rejection of the sectoral grants imply? Not very much in the next financial year, as it turns out, because in the structuring of the year-wise pattern of these grants by the Finance Commission, in the first year, the largest flows under the revenue deficit category. And so for that reason, if the government had accepted all the Finance Commission recommendations, there would have been a transfer of 4% of GDP from center to states. And that is not an insubstantial transfer. When you remember that this is a country which overall, consolidating across central and states, collects only 17% of GDP as tax revenue. So a 4% transfer is not bad at all. When you cut out the statutory grants that they have rejected, that 4% comes down to 3.95%. That's just for next year. In later years, the discrepancy will be much greater. So you can say 4% to 3.9%. What's the big deal? The big deal is, as I said, not the quantum of the reduction, but the fact that these funds will be transferred out of the statutory flow set of transfers, which are very, very disciplined in terms of the timing and the certainty of receipt at the recipient end. They will be transferred to another category, which is still in a big mess in terms of timing and uncertainty of flow. So that is why that rejection worries me. Since I am probably very close to running out of time, let me mention what I think were the two greatest points to be noted about the report of the Finance Commission, of the 15th Finance Commission, especially in COVID times, which is the subject of our panel. The first is, as the chairman mentioned, the huge allocation given to the grant to local bodies. These are rural local governments and urban municipalities. And this grant constitutes 4% of the total provision aggregating across tax transfers and grants. It's a very generous provision. And even more importantly, for the very first time, there is a carve out of 70,000 crores out of that 4% going to health provision at the local body level. And the importance of that can be realized only by the average citizen living in India, for whom access to primary health facilities is very, very poor. So I was extremely happy to see this recognition of the major role that local government can play in the provision of primary health facilities for the communicable diseases, the diarrheas, the headaches, the fevers, the flus, and in the COVID context, COVID, which local governments and quick access to primary health can play. So it's a great achievement. I might also add in parenthesis that the total health provision of the 15th Finance Commission was divided into 3 heads. The major portion went under the local body head. The other 2 provisions went under the sectoral grants and state grant heads, which have been axed. So the government has not fully accepted the total health provision, but because they accepted the local body provision, luckily that health component going to local bodies has been protected. The second very, very big contribution made by the 15th Finance Commission has been their recognition of the need for better performance of the power sector and of discoms, distribution companies, which lie within the jurisdiction of states. So a performance conditionality has been built in to the borrowing conditions, to the borrowing permissions given to state governments. As you know, under the Indian Constitution, state governments cannot borrow from domestic capital markets or anywhere else for that matter without the approval of the central government. So that cap has been placed at 4%, and they've been allowed another 0.5% of GDP if they will undertake power reform at their level. And these power reform parameters have been spelled out. In fact, they were spelled out in the interim report of the 15th Finance Commission. And I'm happy to say that those conditionalities were accepted by the central government when in the middle of the year, because of COVID, the central government itself increased the borrowing cap on states, conditional on their doing power reform along the prescribed lines. So what makes it likely that the final report conditionalities will actually be processed in time for state governments to receive their money is that these conditionalities were already spelled out in the interim report. They've been accepted by the central government in the interim and acted upon. And so processing these conditionalities will not pose any problems at the level of the center. And what is the relevance of power sector conditionalities in the COVID context? huge relevance because a lot of schools, as you know, all the schools in the country have been functioning at a virtual level, and students have to access these classes virtually through smartphones or other devices. And ultimately, even if they are working on batteries, the batteries need to be charged. So it is extremely important that the power sector should function well. And I'm happy to say that the 15th Finance Commission has taken on that task and performed brilliantly in prescribing those conditionalities. I think I'll stop here. I'm sorry about my cough, but I don't have COVID.
Thank you so much for that. That was a really interesting discussion. I want to turn it over to our next panelist, Junaid Ahmad. But first, I just also want to note to people, please remember, if you have questions, please enter them into the Q&A function. I'll be, after the panelists have finished, I'll be bringing some of those questions forward to them. And so please go ahead and enter questions into the Q&A. So with that, I'd like to turn it over to Junaid.
Thank you very much. It's an absolute honor to comment on the 15th Finance Commission and to reflect on the words of Mr. NK Singh. Let me say that Indira ji is right, that the volumes are going to be wonderful, wonderful documents for students of public policy and public finance. And that's a huge contribution on any day when a document can be such an important, if you will, learning document. But I think that there is something else that needs to be recognized. Every finance commission has to maneuver through a political economy. And what I observed Mr. NK Singh do to maneuver through the political economy of low growth, pandemics, and a political economy of changing fiscal federalism in India to produce the 15th Finance Commission itself deserves analysis by those who are looking into the art of policy making and those who are interested in understanding how policy making gets constrained by political economy. This piece of analysis is yet to be done and must be done, because I think when it's done, you'll see how powerful a process the 15th Finance Commission actually entered under the chairmanship of Mr. NK Singh. I had the privilege of, with the World Bank to be part of this process, and one thing that we did recognize is how open the conversations were. Mr. NK Singh brought in the World Bank, brought in the IIEP, the IMF, external agencies very transparently in the dialogue, as he brought in local think tanks, local researchers, and of course the states themselves. And I think the way this kind of commission opens the debate is itself something that ought to be recognized. And I think these processes of the finance commissions, in particular the 15th Finance Commission, should not be underestimated. What I'm going to try and do is reflect a little bit looking forward in terms of what I think the Finance Commission, the 15th Finance Commission, the doors it has opened. So the first story that I would take off from is where Indira left off. And she's absolutely right that you have here a Finance Commission that has taken on the pandemic and put resources behind health, but health at the local level, the primary level, because that is indeed where COVID is unfolding and where COVID needs to be stopped. I would add that this focus on local governments, there are two other dimensions that are extremely important. One is the focus on cities. This is a finance commission that said we need to incubate cities, number one. And number two, it actually put in resources behind controlling air pollution in cities. Now, whether you agree that you should incubate new cities, or whether you agree that cities need to deal with air pollution, what is important is the signaling of local government and cities' importance for India. India is urbanizing. The future of India may well be in the states of India, but in fact, the future of India lies in the third tier of India. The 73rd, 74th Amendment that Mr. NK Singh talked about, the cities as a third tier, well-governed, independent third tier, needs to emerge in India. The question that one has to ask is, are these sectoral grants going to cities? Will it enable that, if you will, emergence of the third tier in India? If you take the United States, for example, United States Constitution, if I'm not wrong, does not talk about a third tier of government. It does not talk about municipal governments. On the other hand, the modern constitutions that have emerged, Indonesia post-Suharto, South Africa under Mandela, talk about an independent third tier. United States, without having put the third tier in its constitution, sees the emergence of a very powerful third tier. Indonesia and South Africa, in its modern version, actually puts a third tier into the constitution. The big challenge in India will be, how will the third tier emerge in India? And by the third tier, I don't mean a city or a rural local government that's driven by vertically fragmented programs, but really come together as a third tier that's managed as an integrated, accountable tier with the accountabilities to the citizens. And here, I think the 15th Finance Commission plays a very delicate balance of putting more resources into the third tier, yes, vertically, but putting more resources into the third tier to enable this third tier to come forward. I think this is a very, very important window that the 15th Finance Commission has raised. My question to Mr. NK Singh would be, why didn't the 15th Finance Commission go further? Perhaps even argue for a portion of the GST to be shared with to the cities, rather than, if you will, vertical programs. I think that's my first comment. The second comment I'd like to make is regarding the equalization. I think this Finance Commission actually has opened the door on the debate on equalization. And it's a debate that needed to emerge in India. The states of India are really diversifying in very different ways. It is not a one where convergence is happening. The differences between states is increasing. And the 15th Finance Commission pivots more into the equalization. But my sense is what the 15th Finance Commission may be signaling that India needs a dramatically different process on equalization, that fiscal capacity equalization is not sufficient to really address the divergence that we're seeing in the states, and that this is going to be a very, very important process going forward, and future finance commissions will have to deal with equalizations. And I think the door has been opened by the 15th Finance Commission. The third area I would argue, which is extremely important, is centrally sponsored scheme. Let me be provocative and say that India is the last of the federation that has not moved from schemes to true intergovernmental fiscal transfers. That everything is still scheme-based versus something that could be per capita based into the hands of the states, and the states have the ability to, different states using the different implementation capacity, to then implement and adopt mechanisms differently. Therefore, sanitation or health in Bihar is definitely going to be different than in Tamil Nadu, is going to be different than in Goa. You can't do this by schemes, but by per capita outcome-based stories. And the 15th Finance Commission, in the way they discuss the health, actually has opened this discussion. There's a dramatic need to shift away from the sectoral-based centrally sponsored scheme, especially in the context where India today, social protection, direct cash benefits into hands of households, women-headed households, individuals, is increasing, that kind of fiscal transfers into individual accounts enables India to move towards a more per capita grant basis at the jurisdiction level. Final point I'd like to put on the table is, as I observe federations around the world, one of the things that's emerging are institutions that enable intergovernmental dialogues to happen. GST Council is one of the most powerful intergovernmental councils that India has. But going forward, India is going to need more of such councils as states begin to engage the center with the states in the future of India. And I was hoping that the 15th Finance Commission would put on the table the story of where should India be positioning itself in creating intergovernmental forum that would allow the dialogue of intergovernmental fiscal relations to move forward. Let me end there and say that it has absolutely been a privilege to have had a chance to work with the 15th Finance Commission. The lessons we have learned for the rest of the world are huge, and I'm hoping that we will be able to get Mr. NK Singh to actually share this with some of the other federations around the world. Thank you.
Thank you so much for that set of comments. I'd like to turn it back over to NK Singh now for a few moments to share any more thoughts that these very stimulating discussions may have raised for him before turning it over to questions. And once again, ask people if they have questions, please go ahead and put them in the Q&A.
I'm indeed delighted and honored at the points made by Indira. Thank you, Indira, for being so warm and so appreciative. You are part of this process. You have been part of many such processes with me in the successive journey that I have undertaken in complex economic policy making. You have made some observations, and I must say that all of them exceedingly well-based and well-argued. First and foremost, that it is true that our recommendations, known popularly as awards, are not exactly awards because they are not necessarily binding on the central government. Now, for them to become binding, the Constitution would need to be amended further. We just not only talk about the fact that the only constraint is that the President, before assigning any resources, must take into account the recommendations of the Finance Commission, if constituted, and that each of these recommendations must be placed at the table of the House along with the action taken report or the explanatory memorandum, which Indira has mentioned. So that is an infirmity in the wording and the evolution of the Constitution, and there's nothing that the 15th Finance Commission or any Finance Commission can do if any of these recommendations were not to be fully accepted by the central government. As it has turned out to be, that Indira is absolutely right, that excepting for this on both on state-specific and on sector-specific, the rest of the recommendations have been, out of the 10 lakh crores which we gave, excepting, keep these two out, the rest of them have been accepted. It would have been, of course, much better if the central government would have accepted them. While they have not formally rejected any, but the fact that they have not provided this year could be partly explained by the fact that this is fiscally a very stressed year. The central government, as it is going to end this year at a fiscal deficit of 9.5%. Next year also, its fiscal targets are quite high. Let's see what happens as we move forward. I totally agree with her that subsuming them in restructured, centrally sponsored schemes may not be the same as really having provided for them in the nature which we had done. She has mentioned about the fact of the centrally sponsored schemes and the fact that the timing of the release of these funding. First of all, I think that Indira knows better than all of us that not only in respect of the centrally sponsored schemes is there uncertainty in the timing, but there is also uncertainty on the funding pattern itself, because many of these have undergone successive changes in funding patterns. This lends an added degree of uncertainty on the centrally sponsored schemes. So hopefully, when these are rationalized, and these are being rationalized, she knows, and Junaid also knows, that the earlier life cycle of centrally sponsored schemes was coterminous with the life cycle of every 5-year plan. They changed that to make it coterminous with the life cycle of every finance commission. So technically speaking, the life cycle of the existing centrally sponsored schemes is coterminous with the life cycle of what our recommendations would be. We made far-reaching recommendations on a deep rationalization of the centrally sponsored schemes, which is contained in our report. The finance minister did say that based on our recommendations, such a deep rationalization is currently underway and will be implemented so soon. So let's see what turns out to be the final outcome of that process of rationalization. I'm grateful to you, Indira, that you recognized this, what we have done for the local bodies and assigning a large percentage also to the health sector, to particularly at the cutting edge of the health sector. It would have, of course, added to the synergy on the health if what we had given, not a big amount, but an amount like 30,000 crores for the health sector as incentive to states to fill up certain health gaps. And also some of the recommendations of the state specific relate to the health sector that have been accepted. Let's see what turns out to be. I'm grateful that you recognize what we have done for the power sector. Particularly, you are quite familiar, Indira, that the power reforms have been one of those which have eluded successive governments and successive dispensations. I recall long ago, and so would you, Indira, that as part of this, what was known as the APDP, the Accelerated Power Development Program, then the APDRP1, APDRP2, almost an APDRP3, then Uday program. And well, we seem to have made progress, but we have a long way to go on the whole power sector reforms, which I am delighted you linked also to the pandemic issue, because the reliability of power in times like this and the need, therefore, for health sectors, for education in terms of imparting things is critically dependent on the efficiency and the predictability of the power sector. But the end, Indira, let me say that I'm indeed most flattered and grateful for your very generous endorsement of the 15th Finance Commission. Coming from you with this rich experience which you have in economic policy meeting, this is indeed very heartwarming. Junaid, thank you for mentioning the initiatives on the health sector and at the fact of getting the cutting edge, namely the local government involved in the health sector parameters, and recognizing what we have done for incubation of new cities, in which through a challenge fund, we have assigned resources that at least some 8 new cities will come up in a country which really has suffering from huge congestion of cities. And where this pandemic, if there's any lesson it taught us, is that places which are very congested are more prone to contracting infections than those which are living in dispersed places. And we did assign, of course, as you recognize, and you played a key role on this, Junaid, on the air pollution, where we have, for the metro cities, which have a population of more than 1 million, we have assigned large resources based on certain well-accepted parameters on air pollution for them to be incentivized in this direction. You have mentioned some very, very difficult issues. How does one move to a true independence of the third tier? This indeed was a quest of the 73rd and the 74th constitutional amendment. Why was this quest not realized? This quest was not realized, in my view, for two important reasons. One was that in making the constitutional changes, there was a degree of infirmity. It was expected that the devolution of powers, functionary, and finances to be assigned, the three Fs to be assigned to the third tier, have been done very imperfectly and at the discretion and the latitude and the inclination of state governments. No government, with a central government or the state government, is happy to part with power. It is part of the constitution of human beings that we would like to hang on to it for as long as we can. To expect the state governments with alacrity would devolve genuinely all the three Fs was perhaps needed to be embedded in some constitutional provision. So I think that if we look forward, I think maybe the infirmity or a new schedule needs to be added in the changes along with the 73rd and 74th constitutional amendment to give this issue a degree of urgency and heft which is necessary. And that's an area on which further debate, I think, will help in crystallization of opinion. You asked the question of why did we not, for instance, look at the issue of foreclosing a part of the GST revenues for the third tier? Well, we toyed with this possibility. We then realized that the constitution of the GST Council was, and the opaqueness in our responsibility with the responsibility of the GST Council was a gray area, and that by foreclosing a part of the GST revenue to the third tier, there would be an inherent danger in the Finance Commission overstepping its mandate assigned to it in a manner which may become legally untenable. But I did say in my opening remarks that the area of and the relationship between the Finance Commission and the GST Council is an area where much more work needs to be done. Indeed, you ended your comment by saying that we need independent arrangements for intergovernmental dialogue on an ongoing basis. We have made one suggestion in the Finance Commission. We have suggested that looking at fiscal uncertainties, we need to constitute a high-level intergovernmental committee. I've used the word intergovernmental because it means the union government and the state governments as well, and that is therefore intergovernmental, on the area of fiscal policy and the overall policy framework. This recommendation is also currently being considered by the central government, but they have not given their opinion one way or the other so far on whether they will accept this recommendation as we go forward. But we made one suggestion. The other area which I think that deserves going back to the drawing board is we do want to have an ongoing relationship of a permanent nature as an ongoing dialogue between the center and the state and the GST Council. We need to look at the future of future finance commissions and future such intergovernmental bodies. With the abolition of the Planning Commission, the debate is up in the air on whether the institutions for an ongoing dialogue between the center and the states, what we need to do. Is it the rejuvenation of the Center State Council, a constitutional body, invested with a new mandate and a new purpose? Or do we need to look at other institutional arrangements? That indeed is an issue on which we need to really give further thought to. You also raised the issue of the processes of equalization, a very important fact. I agree with you entirely that we need to move away from a scheme-based approach to a broader outcome-based approach. How do we do that? We toyed, frankly, with the idea, Junaid, that could we make the devolution of the state's resources based on per capita income? And what would be the outcome? The outcome would have been that many states which have achieved much higher rates of economic progress, what they call improved matrix of governance, investment in skill inculcation, health and education, may have turned out to be big net losers if we moved away from the current normative approach by assigning 4 or 5 criteria to a per capita based approach in the devolution of resources to be assigned. So we need, however, to discuss the entire issue of equalization and the equalization debate on whether the current approaches, which are based on such fiscal transfers, need to be revisited. But that is an important issue which you have raised. So Junaid, I think that let me thank you for all the cooperation which you extended to the 15th Finance Commission. I do so publicly yet again. I do so with humility and recognition, the great contribution of the institution which you represent, and your own personal contribution to shaping many of our key recommendations. I recognize that the issues which you have raised, the unsettled areas still to be debated, deserve much greater attention than has been possible so far. I'll stop here in my comments to the 2 points raised.
Thank you so much. That's a very helpful kind of response to what we've heard this morning. There's one question that came in that I think speaks a lot to some of the conversation so far, which is much of the conversation talked about devolving more funds to the local government, local governments. And one of the questions was, how do we think about the accountability that or independence they should be able to get in those settings? And so that is when money is flowing from the top towards the bottom, often it comes with many strings and many cooks in the kitchen. And how do we make sure that the local governments have the independence they need, but at the same time have some accountability over the funds that are flowing towards them? And so I'd start, I think, with NK, but if either of the other panelists want to chime in as well.
First, let me comment on the accountability. On the accountability, for the first time, we did decide to make what we called entry conditionalities. For instance, properly audited accounts, accounts all to be integrated on an acceptable platform, has been now made an entry condition after the first year. So this is one entry condition. The other entry condition is the constitution of state finance commissions, which are basically under the constitution expected to give recommendations for the financing of the third tier, has also been made an entry condition after the first tier. Both these improve the ability of the third tier for garnering additional resources than is currently possible. And the third important area, which directly links to the issue raised by you and by Junaid, is that considering the fact that the GST has subsumed many of the sources of revenue of the third tier, we explored at what options existed. One of the things which we have recommended very strongly is that one instrument of financing and revenue, which has been neglected over the years by all state governments, particularly the third tier, is the issue of property tax. On property tax, we have made that a performance criteria. First, the fixation of a threshold reserve property tax, and then of linking it up in some form or the other, indexing it to the rate of growth of the state's per capita rate GDP growth. So a property tax is going to be able to give, I believe, the third tier an avenue for financing, considering the fact that many avenues of such financing have been subsumed in the GST, which is why Junaid's question on the proportion of the GST being assigned was a very relevant one. So I'll say that as we go forward, we need to look at making third tier financially viable, financially independent, to make them genuinely, therefore, an important tier of governance suited and designed for local needs. And recognizing the important role that urbanization is going to play in India in the coming decade or so, and that the pace of urbanization was gathering momentum, we did pay significant attention to urbanization, but they're also, I think, that making them true engines of growth. We need enabling urban cities and municipalities to achieve greater financial viability. Let's stop on this.
If I could add to this question of accountability, that one of the most important linkage of accountability is when the service provider at the local level, whether it's solid waste or water or transport, responds to the local citizens. And for that to happen, you have to really move the service delivery mechanisms away from a state managed to a local government managed. So Shimla today has inherited the water system to run Shimla. That brings accountability to the local level. But the other element of accountability is user charges. If user charges are not levied, then the citizen is not going to hold the service provider accountable. And in a context where India is moving towards direct benefit, direct cash benefits according to income, where you can provide an income support, you can begin to increase the user charges so that it reflects an accountability, direct accountability between the provider and the citizen. This is a very important arena of accountability that I think, along with property tax, needs to be explored, especially given that the center is providing social protection for the low income. So the issue of equity need not be sacrificed if one brings in more user charges.
Thank you. Indira, anything to add on this?
Yes, I do want to add something on this. While I do agree with NK Singh and Junaid Ahmad that local governments need to have more funding at their discretionary control so that they can deliver services better, at the same time, one must not make the mistake of ascribing greater fiscal virtue to local government than to governments at higher levels. Now, of course, NK Singh made the very important point that an entry-level condition has been imposed that local governments and discoms particularly should have their accounts formally audited, and that is certainly one important thing. But what auditing can often miss is delayed payments, which is a disease that afflicts all levels of government in India, center, state, and local. And in fact, one of the biggest areas of delayed payments and unpaid bills is the liabilities that local governments owe to utilities. They don't pay their water bills. They don't pay their electricity bills. And this is really a national disease. So auditing may not necessarily capture that. What auditing captures is misuse or abuse of funds, but it cannot capture unpaid bills unless you have accrual accounting. So in the present cash accounting mechanism, these things have to be taken on board. So yes, by all means, more funding, more discretion to local bodies, but at the same time, some way by which to control these proclivities for the delayed payments.
Great. At this point, I'd like to turn it back over to Ajay.
Yeah, thank you very much. That was such a rich discussion. I just wanted to say that of course, I think the issue of property taxes and user charges is really the future for where we have to go, and I'm so glad that it came out at the end here that is without ability to raise their own resources, local government will never be properly empowered. There's also the issue, of course, that we have states like UP which were it to be a separate country, it would be the 5th largest country in the world. So the issue of how many states India should have with a projected population of 1.5 billion Probably if you have an optimal size of about 30 million, India should become 50 states, we should have 50 states. But that's obviously not the purview of the Finance Commission. I mean, there is a certain freshness that every Finance Commission brings. So perhaps having a bureaucratic or sclerotic old planning commission arrangement may not be the best, and maybe this is probably the way to go. I don't know, but it's something, you know, as NK has also been chairman of the FRBM committee, some sort of a fiscal council embedded within a finance commission is obviously also needed. And anyway, congratulations, NK, for your talk today, but also for navigating India through navigating the Finance Commission through these minefield of issues. A bigger minefield is awaiting us because the shares of seats in Parliament, which are now based on the 1971 census, will at some point have to shift to the 2011 and maybe even the 2021 census. And perhaps the government should, considering how well you have navigated this minefield, should consider you to be the person who will take us through this minefield, and then you will be known as the Thomas Jefferson of India if you were able to get us through that particular minefield. But thank you so much, and let me thank you all, and to Indra and Junaid as well. Thank you.
So I believe we're out of time now. I would just on behalf of IIEP like to sincerely thank our panelists. It was a wonderful conversation, and once again thank Ajay Chiver for organizing these panels. They're incredibly informative and have been a real bright spot of stimulating discussion over the last number of months. So thank you once again to everyone, and have a nice rest of your day, or for those of you who this is the end of your day, good evening.